The man who wrote the AI Bible just lost $35 billion in 3 weeks. Leopold Aschenbrenner, former OpenAI safety researcher, author of the manifesto that predicted AGI by 2027, the document passed around at the highest levels of government and investment, built a hedge fund on the AI infrastructure thesis. It returned over 1,000%. It was managing $45 billion at the start of July. By the end of July, Goldman Sachs, JP Chase, and Bank of America had issued margin calls. He sold his entire public equity book in a single block trade to Ken Griffin's Citadel at a discount. And 2 weeks later, Silicon Valley insiders were lining up to give him more money. This is the story of what happens when the smartest person in a room meets the oldest trap on Wall Street, and what the aftermath tells us about where AI capital is actually going. Leopold Aschenbrenner published a 200-page AI manifesto in 2024 called Situational Awareness, the decade ahead. It predicted AGI by 2027. It was read at the highest levels of government and investment. It is still the most cited document when people try to explain why the AI arms race is moving as fast as it is. He was fired from OpenAI that same year for allegedly leaking safety concerns to investors. He launched a hedge fund, also called Situational Awareness, on the thesis that AI infrastructure was being systematically undervalued. He was completely right. The fund returned over 1,000%. Assets grew from $100 million to $45 billion in 18 months. Then the leverage that had amplified every gain amplified every loss instead. 3 weeks. Everything gone. And here's what nobody is saying clearly. The people who understand exactly what broke and why are now the most valuable AI capital allocators alive. The story of what comes next is more interesting than the collapse itself. The fund's largest positions: CoreWeave, Nebius, SanDisk. CoreWeave, purpose-built GPU cloud. Microsoft, Meta, and OpenAI are its largest customers. Nebius, European AI cloud, GPU-dense data centers across the continent, built on the thesis that European compute demand follows the US curve 18 months later. SanDisk, flash storage for AI weights and inference cache. All correct long-term theses. All real companies. All real demand. But in the second week of July, Morgan Stanley published a note questioning whether hyperscaler AI capex was approaching saturation. Microsoft guided conservatively on next quarter Azure AI revenue. CoreWeave missed on a single line item, data center power costs, and dropped 17% in one session. With 4 times leverage, a 17% drop in a core position reduces your portfolio by 68% on that position alone. The prime brokers started making calls. The thesis was right. The structure couldn't survive the path to being right. And how it collapsed in 3 weeks is more instructive than the headline number. If the economics of AI capital, who controls it, who loses it, and why the same people keep getting it back, is what you track, subscribe. We publish every Tuesday and Friday. 4 times leverage means this. You have $10 of investor capital, you're controlling $40 of positions. You borrowed the other $30 from your prime brokers against the value of your portfolio. When positions rise, it's extraordinary. Every dollar of appreciation generates $4 of portfolio gain. That's how a fund grows from $100 million to $45 billion in 18 months. When positions fall, the math reverses fast. Your collateral drops. At some threshold, the prime broker issues a margin call. Post more or we force sell your positions. In the second and third weeks of July, CoreWeave dropped. Nebius fell 48% from its May peak. SanDisk dropped 56%. The fund had also been short software names, Adobe, Salesforce, on the theory that AI would erode their margins. Those shorts moved the wrong way. Goldman issued the first margin call. JP Morgan and B of A followed within 48 hours. Aschenbrenner's letter to investors: "We let you down this month." And "We came closer to permanent capital impairment than is acceptable to us." He sold the entire $16 billion public equity book to Citadel in a single block trade. Citadel bought at a discount large enough to make the trade worth executing immediately. The oldest lesson in markets. Now with the author of the AI Bible on one side of the trade and Ken Griffin on the other. This collapse doesn't happen without the specific capital environment 2026 created. Q1 2026, $297 billion in global venture deployed. AI captures 81%. OpenAI's single $122 billion round is 40% of all global venture capital for the quarter. For companies takes 64 cents of every dollar. That concentration creates a two-tier structure. Tier 1. The frontier labs, priced at valuations that require decades of perfect execution. Tier 2. Every other AI company, including the infrastructure plays Aschenbrenner held, competing for 19% of the market. The infrastructure stocks were priced on the assumption that hyperscaler CapEx converts perfectly to revenue. When Microsoft guided conservatively on one quarter, it forced one question. What if $500 billion in CapEx commitments doesn't land on schedule? That single question repriced the entire infrastructure layer. Aschenbrenner was right about the 5-year destination. He was wrong that the path there would be linear. With 4 times leverage, linear path is the only acceptable scenario. Every technology cycle runs this story. .com crypto, now AI infrastructure. Genuine insight, leveraged conviction, volatile path, margin call. The thesis survives. The fund doesn't. And the person with the most valuable post-mortem in the room is the one who held it through the worst quarter. Which is exactly why Silicon Valley is now trying to give Aschenbrenner more money, and why the answer matters. Citadel bought the entire $16 billion public equity book in a single block trade, at a discount, because Aschenbrenner had to sell immediately to satisfy 3 simultaneous margin calls. The underlying assets didn't change. CoreWeave is still building data centers. Nebius is still deploying GPU clusters. The thesis Aschenbrenner was right about transferred from a forced seller to a patient buyer at prices the market had just moved against. There is no better trade than buying from a forced seller. The price reflects their constraint, not the value of what they're selling. This is the asymmetry Wall Street has known for 100 years. The person right about a thesis and the person who captures the return are not always the same person. The return goes to whoever holds through the volatility. Citadel holds. Leveraged conviction funds don't, when their prime brokers call. Being directionally correct is necessary. It is not sufficient. And what's about to happen next is the part that everyone in Silicon Valley is suddenly very interested in. 2 weeks after losing $35 billion, Silicon Valley insiders are asking to give Aschenbrenner more capital. The fund is telling them no, for now. Not because the strategy is broken, because the terms aren't right yet. This is not insane. It's a precise calculation. The person who built the most sophisticated AI infrastructure thesis available survived a catastrophic unwinding of it and documented exactly which variables he was wrong about. That person is now the most informed AI infrastructure investor alive. He knows which positions cracked first under pressure. He knows the leverage ceiling the volatility actually requires. It isn't 4 times. He knows the quarterly cadence that can unwind a 5-year thesis in 3 weeks. That postmortem is worth more than any research note Morgan Stanley will publish this year. Every investor who missed the 4 mega rounds needs another structure for AI exposure. Aschenbrenner, post-collapse, deleveraged, with a documented failure analysis, is a credible answer. The fund is saying no because the queue is long enough that they can dictate structure. Lower leverage, longer lockups, different collateral terms. The next fund will be designed to survive the volatility that destroyed the first one. The fire sale didn't kill the thesis. It clarified what it costs to hold it. And Citadel, who bought the entire book at a discount, is now finding out if that's true. Leopold Aschenbrenner wrote that the AI transition would be the most consequential economic event in human history. He built a fund to profit from it. The fund returned 1,000%. Then it lost 67% in July. The fund manager wrote to investors, "We came closer to permanent capital impairment than is acceptable to us. 2 weeks later, Silicon Valley is lining up to give him more capital. The Citadel trade is the most instructive detail. Not that Aschenbrenner lost. That Citadel bought. The Thesis transferred from a forced seller to a patient buyer at a discount. CoreWeave is still building data centers. Nebius is still deploying GPU clusters. The infrastructure is still being built. The returns will accrue to whoever can hold through the volatility without a prime broker calling at 6 a.m. Being right about AI is not the same as profiting from AI. The first requires intelligence. The second requires structure, patience, and no margin calls. To track who is structurally positioned to capture AI returns versus who gets margin called out of them, subscribe. We break this down every Tuesday and Friday. Drop a comment. Should Aschenbrenner take the new capital? And what leverage ceiling would you set on the next version?